Good morning, ladies and gentlemen. Welcome to the yearly briefing about the EIB's results in 2017. My name is Matteo Maggiore. I'm Head of Communication, and I'm here on the podium with President Werner Hoyer, President of the EIB, Mario Santoni, Deputy Secretary General, and Pierluigi Gilibert, Head of the European Investment Fund. There are several other vice presidents of the bank and senior colleagues in the room. You're very welcome to talk to them in the margins of this press conference, and they will be happy to take questions as relevant. It's a special year for the bank, 60th anniversary. We plan to be in Brussels a bit more often in the coming months and more regularly, so we'll have many opportunities to talk. President Hoyer will introduce and present the results, and then we'll have time for Q&A. So without further ado, I would give President Hoyer the floor.
Thank you very much. Thank you very much, Matteo. Happy New Year, ladies and gentlemen. Welcome to our annual press conference. I intend to do this together with Mario Santoni, the Deputy Secretary General of the bank, and Pierluigi Gilibert, the CEO of the European Investment Fund. It's a pleasure to talk to you today because we can give you some good news, which should be normal for the good news institution of the European Union. So we have some good figures to tell you. But this time it is not only to talk about last year. This is a special year. This year the EIB, the EU bank, is celebrating the 60th anniversary of its foundation. Enshrined in the treaties of Rome, it came into existence in 1958 with a mission to, as the treaty says, to contribute to the balanced and steady development of the internal market in the interest of the Union, the communities at that time. More specifically, the EIB was created to enhance cohesion across Europe by financing projects in less developed regions, to help modernize Europe's economy and to fund projects of common interest to several member states. So, development of an internal market and cohesion were the main themes when the treaty was written. Nobody at that time would have thought about climate change action. Nobody would have thought about the priority for energy efficiency or renewable energies. All these were mandates that the European Council gave the bank afterwards. But the basis has been laid down in the Treaty of Rome more than 60 years ago. The bank, like the EU project itself, has always evolved with the times. As the European Economic Community became the European Union, the EIB became the EIB Group with the establishment of the European Investment Fund. And together, it has assumed the identity of the Union's financial arm, the EU Bank. We have reached 162 countries. We have engaged in close to 12,000 operations globally and disbursed over 1.1 trillion euros. This has mobilized up to 3 trillion euros of investment, a very efficient use of EU resources. This has been a good deal for Europe and an enormous benefit to the EU citizens. After all, only 14 billion euros have ever been paid in cash by the owners of the bank, the member states, a little more than 1% of the total investment this bank contributed to generate. So it has been 60 very good years. We can prove these investments have had a tangible, sizable impact on the European economy and on the life of Europeans. You can measure it in a lot of different ways. Take the 11,000 megawatts of power generation capacity that we helped create last year, almost 100% of which was from renewables. Or the 2,000 families in EIB financed affordable social housing. Our impact can also be measured in GDP and in jobs. Our economists figured out a way to bring all this together using an econometric model created by the Joint Research Institute in Sevilla. This institution of the European Union found out that EIB Group supported investments in 2015 and 16 alone will have created 2.25 million extra jobs after 5 years and generated a 2.3% increase in EU GDP. That's the short-term boost. But more importantly, these EIB-supported investments will have an impressive long-term impact on productivity and competitiveness. After 20 years, we estimate that those same investments will still support around 1.27 million extra jobs and GDP that is 1.5 percentage points higher than it would have been in a baseline scenario. I repeat, this is the macroeconomic impact of 2 years of investment. But let's take a quick look at last year first. In total, EIB Group signed more than 78 billion euros in financing in 2017. I'm especially proud that we managed to increase lending for innovation in various industries to a total of close to 14 billion euros. Innovation is at the heart of competitiveness and ultimately sustained and sustainable growth. It is also an area in which Europe must close a significant gap between it and its main global competitors in terms of investment. In 2017, close to 7 billion euros went to environmental projects and 18 billion euros into infrastructure. And the EIB once again met its targets for climate action, with approximately 19 billion euros of financing representing over 27% of 2017's total EIB financing. We had committed to 25%, we reached 27%. The largest share of our financing, close to 30 billion euros, went to small and medium-sized companies and mid-caps. We estimate that this financing sustained 3.9 million jobs in more than 285,000 firms. But what I really want to draw your attention to is this. In 2017, we approved more projects than ever, 901, a roughly 15% increase from the previous years. The average size of the projects we finance is smaller than previously. This means that we are enabling more and more firms and public entities to invest. We are really combing through Europe to find companies with good ideas, companies with a business plan that will drive Europe forward. And we are working on advisory assignments, mostly in cohesion countries, but not only, that may generate a total of up to 40 billion euros of investments. And through our advisory services, we're also reaching a wider range of project promoters, filling the gaps and addressing the real needs of the market. A big part of why we are able to do this is the investment plan for Europe, the Juncker plan, and specifically the European Fund for Strategic Investment, one of the core elements of the Juncker plan, which is backed by an EU budget guarantee and the EIB's own funds to finance riskier investments. Remember the history of the Juncker plan. In 2013, we were confronted with the situation that our economists calculated an investment gap in Europe of 700 billion euros of investment. 700 billion. That comes from a comparison between the targets set by the European Council for the different areas, from research and education to infrastructure and SMEs, compared to budget figures and corporate budgets foreseen until 2020. And that comparison leads to 700 billion of investment gap. And at that time, go back to 2013-14, we had a situation where liquidity was not a problem in Europe anymore. Europe was swimming in liquidity at that time. Liquidity was available abundantly. So at that time, the question was, why do these funds not go into good projects that are available? And the response that the European Commission and the Council and Parliament gave was, well, obviously, there is a question with perception, with expectations, with confidence, and with risk aversion that led to the idea to say, okay, why don't we reserve a small part of the EU budget, 16 billion out of 1,000 billion, to shift from grants and subsidies to guarantees and loans in order to make it possible to finance riskier projects by offering a first loss piece in case a project goes wrong. This has led to a significant increase and a partial closure of this investment gap of 700 billion euros. And that means roughly 100 billion euros of investment gap per year less. So this is the basic story of the Juncker plan, quite a simple idea. Shifting money from grants and subsidies to guarantees and loans. And this is one of the most courageous steps that Mr. Juncker and then Budget Commissioner Kristalina Georgieva dared make. They went into this exercise upon our advice, by the way, and it had proven to be very successful. By the end of 2017, we had approved 717 FC transactions, mobilizing 257 billion euros, or 82% of FC's original 315 billion euro target, which we are well on track to reach in the coming months. More than 90 billion euros of that came in 2019. We have supported thousands of companies and hundreds of thousands of jobs and played an important role in Europe's recovery. When we launched the Juncker plan in 2015, some called the plan's ambition to generate 315 billion of additional investments from a guarantee of 21 billion a delusion, mentioning black magic or financial wizardry. We said at the time that the multiplier of 15 over the basic guarantee was achievable. We are now vindicated. It has worked. We welcomed the decision of the European Parliament in December to extend this program to the end of 2020 with an increased goal of mobilizing 500 billion euros of additional investment. EFSI is a great example of what the EU Bank can do to help scarce resources achieve more. It is a spectacular endorsement of the fact that the paradigm shift from grants and subsidies to guarantees and loans is a very strong tool in Europe's policy kit. More generally, I believe what the EU Bank can do for Europe and Europeans has been underestimated. Let me say something that should be there for all to see, but isn't. Europe has been and continues to be a very good, actually wonderful thing for Europeans and for the world. Someone recently said, quote, "A strong, united Europe is a necessity for the world because an integrated Europe remains vital to our international order. The European Union remains one of the greatest political and economic achievements of modern times." End of quote. I completely share this sentiment. The only problem with these words is that they were not uttered by a European leader, but by then President Barack Obama. In these troubled days, it would be a rare thing for a European politician to express such pride and passion for European integration. And yet, we should remind Europeans of the importance and magnitude of Europe's achievements much more often than we actually do. The resources we have at our disposal are constrained, not least by the impending departure of the United Kingdom. So we in Europe as a whole need to step up our efficiency. This means more emphasis on financial instruments. For this reason, we are engaged in extensive dialogues with the Member States, the European Commission, the Parliament, to make financial instruments more effective in the European Union's multi-annual financial framework post-2020. The need for this kind of paradigm shift towards financial instruments is perhaps clearest in the area of development. As an example, to achieve the UN Sustainable Development Goals, we must close an annual financing gap of around 1 trillion euros for infrastructure in developing countries. Countries are currently filling only 10% of this gap, mostly in grants. Obviously, it is not enough, and public budgets around the world will never be enough in order to reach the Sustainable Development Goals. Never, ever. At the same time, institutional investors globally hold 63 trillion euros of assets under management. Yet less than 3% of pension funds portfolios invest in any kind of infrastructure. It is even less for developing countries. Increasing this proportion to 5% with a focus on developing countries could largely close the financing gap for the Sustainable Development Goals, and this is the private investment that we will try to mobilize. Ladies and gentlemen, the effects of climate change are very real and form a part of what is at the root of migratory pressures. Indeed, migration is a serious challenge that has directed the spotlight on the need to do more and give people everywhere the prospect of stability and prosperity. Even there, also there, a paradigm change is needed. A paradigm change from the perception of development policy as, so to speak, global social policy towards the development of economic perspectives for people on the ground in the countries where they live. We need to turn international assistance into a global compact for prosperity. This is the ambition which underpins the Sustainable Development Goals. On this note, we have begun a discussion with our board, the Member States, the European Commission, on establishing a dedicated structure within the EIB Group, not a new institution, within the EIB Group that is fully devoted to development finance. And EIB is already the EU's key instrument for development banking. Our investment outside the EU makes us one of the largest multilateral development banks with an annual financing volume of roughly 8 billion euros. In 2016, at the request of the European Council, we quickly set up the Economic Resilience Initiative for the Western Balkans and the Southern Neighborhood in the aftermath of the first round of the migration crisis. The results are already impressive. Around 1.5 billion additional euros have been approved for over 20 projects in the region, 2 regions. The EU Bank is living proof that multilateralism, partnership and cooperation work. And we plan to do better. We will continue to help Europe by ensuring Europe helps others. And we will organize ourselves to make sure we reap every bit of efficiency and effectiveness we can squeeze out of our operations. Despite improvements in economic indicators, there is still a need for more investments inside Europe too. The 78 billion euros of projects we signed last year represent about 150,000 euros of investment every minute. So while I have been speaking to you today, the EIB has invested on average almost 3 million euros. But sheer volume is not the key here. I told you we're combing Europe for investment potential. One way in which we do that is our annual investment survey. And let me, at the end of this presentation, give you a short overview what the outcome last year was. On the macro level, Europe's performance has improved. The EU has now experienced 19 consecutive quarters of GDP growth, and the pace of growth in 2017 surpassed official expectations. The EU's unemployment rate is at 7.4%, still, of course, much too much, but fallen almost every quarter from its peak of 11% in early 2013. And investment has recovered to near pre-crisis levels. However, our investment report shows us that A, investment in infrastructure is still lagging, particularly in those countries hit hardest by the financial crisis and subsequent fiscal constraints. Investment in infrastructure is still 20% below pre-crisis levels. B, a full third of local municipalities say they haven't been investing enough in infrastructure. C, EU investment in key areas such as research and development, climate and environment, and strategic infrastructure remains below levels required if we are to meet the targets we have set ourselves in these areas. The same is true for security and defense. D, likewise, there is a need for targeted support for SMEs, in particular small firms, young firms, and innovative firms that invest in intangibles and cannot offer much collateral for bank financing. And let's remind ourselves of the fact that other than in the United States, in Europe, 75% or more of corporate financing comes from banks and not from the capital markets. So this is a major difference to the situation of our most important competitor across the Atlantic Ocean. E, because of our continent's demographic challenges, innovation is the only path to higher productivity, employment, and competitiveness. There is a common belief that in good years, one should save for the more difficult years. In fact, in the good years, one should invest for the more difficult years. The demand is clearly there. The EIB is making investments that go a long way toward meeting this demand, and we are developing new ideas that will encourage others to join us, because we are the crowding-in institution of the European Union. We never finance alone. We always finance together with others. And when our engineers put an approval stamp on a project and say this is technically and economically a good, sustainable, economically viable project, then all of a sudden other investors are ready to join as well. So this is crowding in at its best. And in addition to that, we go to the markets every year to borrow money, 70 to 90 billion euros per year, depending on reflows. And this is another form of crowding in private investors into projects that are in the public interest. Let me look forward. I look forward to 60 more years of progress through cooperation and cohesion, doing more for those who need more, and bringing value, real progress for everybody. We will strive to get better and better in the second phase of FC. SME financing as a proportion of the total will increase from 26% to 40%. We will be more active in dual-use technology for both defense and civilian applications. We will achieve more in development finance and in support of the Sustainable Development Goals. We will make the European economy more innovative, cohesive, and competitive. In its first 60 years, the EU Bank has delivered investments worth over €1 trillion based on the cash contribution by the member states of 14 billion euros. Ladies and gentlemen, this is not the case for any other bank in the world. 14 billion euros of cash injection. By the way, the last 10 billion of these 14 billion came only in 2013, until it was 4 billion. And out of this, we financed an overall balance sheet of close to 600 billion euros and a number of EIB bonds flying around the world of roughly 500 billion euros. Imagine that multiplier. It's enormous, out of 14 billion euros. And I assure you we will build on that, increase our impact, and increase our relevance during my second term as president, which is just now starting. Thank you very much, and together with my colleagues, I welcome your questions.
Thank you, President.